I want to show you something almost nobody in this space is willing to show you, and it is not a price target. It is the road that gets you from here to that price target because you have already heard the headline numbers. $20,000 gold, $1,000 silver. Those come from David Hunter, a macro strategist who has been forecasting markets for over 40 years, and this is verified, publicly documented research. Most channels take his headline number, slap it on a thumbnail, and stop right there because a big number is easy content and nobody has to explain the reasoning behind it. I am going to do the opposite. I am going to walk you through the entire sequence in order, step by step, and there is a section in the middle of it that is going to be genuinely uncomfortable to hear. I went through his complete framework this week, and here it is in one line, so you know exactly where this is heading before I explain any of it. The stock market goes significantly higher first, then it collapses, then gold and silver fall too, then $20 trillion gets printed, and only after all of that do you get the numbers everyone talks about in the title. That third step is the one I want you to really sit with, because if you are holding metals right now and nobody has told you they fall in the middle of this sequence, you are exposed to the exact thing that destroys people who were actually right about the bigger picture. So here's a quick question before we go further, and I want your honest answer in the comments. Right now, today, are you positioned in a way that could survive gold going from $7,000 back down to $3,500 without you panic selling? Not whether you think it will happen, whether you would actually survive it financially and mentally. Be honest with yourself here because this matters more than any target number. This is the hidden economy, and I'm glad you're here with me. Let's get into it properly. Step one is where I lose about half the audience, so let me walk through it carefully. The stock market is not finished going up. In fact, the argument is that the largest and fastest part of this entire move has not even happened yet. Hunter's targets are the S&P at 10,000, the NASDAQ at 36,000, and the Dow at 70,000. From where we sit today, that works out to somewhere around 25 to 30% more upside, and he expects this to play out within the year. Now, why would a market that already looks expensive keep climbing that much further? The answer comes down to who still isn't in it. Institutional investors have fought this rally since late 2022. Every time the market sold off, they got more bearish. Every time it recovered, they were forced to chase it higher. That pattern is what's known as a wall of worry, and it acts as fuel for the rally rather than a warning sign. A market keeps climbing when the people who need to own it still don't own it, because their buying is still ahead of them rather than behind them. And the signal that this phase is ending isn't found on a chart. It shows up when the doubters finally capitulate, when the strategists who spent 3 years being cautious suddenly start raising their targets aggressively, when everybody agrees the rally has years left to run, and when nobody is being careful with money anymore because it all feels easy. That shift is starting to happen right now, which is exactly why Hunter believes the top comes this year rather than years down the road. Now, here's the part I think is genuinely the most useful thing in this entire breakdown, and it's a warning about your own psychology rather than about the market itself. If you get out too early, months before the actual top, you expose yourself to something arguably worse than losing money. You expose yourself to watching a final vertical run happen without you in it. Think about what that does to a person over time. You sell and it goes up 20%. You tell yourself you were just early, it goes up another 20%. Now you're watching other people make 2 years of returns in 2 months. And every voice around you keeps saying it still has years left to run. Eventually you break and you buy back in right at the top. That's not a hypothetical scenario. That is the single most common way people who correctly predicted a crash still ended up losing money in it. Being right early and being simply wrong look identical for a while, and most people can't hold that distinction in their head long enough to stay disciplined. So if you decide to step back from risk, decide it properly, and then don't let that final leg of the rally drag you back in. That discipline is what this entire framework rests on. Step 2 is the bust itself. Hunter is calling for a genuine credit crisis, bigger than 2008, with major indices falling as much as 80%. On the S&P, that means dropping from 10,000 all the way back down to around 2,000. His reasoning isn't really about valuations, it's about leverage. There is currently over $330 trillion of debt sitting in the global financial system, and this is verified data. Leverage works in both directions. On the way up, it magnifies every gain, which is exactly what markets have been enjoying. On the way down, it does the same thing in reverse, and that's precisely what happened in 2008. Interestingly, he isn't calling for governments to default because they simply won't, since they have the ability to print. Instead, he places the real pressure point in private debt, commercial property, private equity, and private credit, the parts of the financial system that have grown enormously over the last decade with far less scrutiny than traditional banks receive. He also describes Japan as the wild card in this whole scenario because it spent decades running near zero interest rates, which made it look like money could be printed forever without real consequence. Now, inflation is showing up there, rates are following it upward, and the country has very little room left to absorb that shift. There's one more claim from Hunter that I think deserves more attention than the crash number itself. He believes this year marks a secular top, not just a normal cycle top, but a generational one. His comparison point is Japan back in 1989, where the market peak stood untouched for decades afterward. He dates the current bull market's origin to August of 1982, when the Dow sat at 780 points, and he was actually managing money at that time, so he remembers that number firsthand. That's 44 years of rally, which means almost nobody investing today has ever experienced the other side of a top like this. The entire buy and hold, never worry about it mentality was formed entirely inside that 44-year window. If that window closes, the strategy that has worked for over 4 decades simply stops working, and most people won't even notice for years. Now, step 3, and this is the section the whole title is really about, because gold and silver fall too. Hunter's targets for this current cycle are $7,000 gold and $200 silver. Then in the bust phase that follows, he sees gold retracing roughly 50% down toward $3,500 to $4,000. Silver falls even further, somewhere between 50 and 75%, potentially back down toward $50. I want you to actually sit with those numbers rather than scroll past them, because this might be the most important thing I tell you this month. Silver goes to $200 and then falls back down to $50. Why does that happen? Because the bust itself is deflationary. When a credit crisis hits, everything gets sold, including good assets, and often especially good assets, because those are the ones that actually still have buyers. Anyone who urgently needs cash sells whatever still has a bid, and gold always has a bid. That's exactly what happened in 2008, when gold fell from around $1,000 to below $700 before eventually going on to make new all-time highs. So the honest version of this bull case isn't a straight line upward. It's a very large gain, followed by a brutal drawdown that will genuinely feel like the entire thesis has failed, followed by the real move higher afterward. And here's why this matters more than any single price target. If you're holding metals with leverage, with borrowed money, or in a position size so large that a 50% decline forces you to sell, then you simply don't make it to the $20,000 part of this story. The math on that is simple. You get removed from the trade during step 3, and everything that happens afterward happens entirely without you in it. And being right about the destination is worth nothing if the road along the way takes you out of the trade completely. That's not a reason to avoid this trade altogether. It's a reason to size your position so that a 50% drawdown is survivable rather than fatal, which means no leverage and a position you can genuinely sit through and hold even while watching it cut in half. Step 4 is the printing, and Hunter calls this the most predictable part of his entire forecast, and I think that framing is correct. When a financial system is genuinely in freefall, central banks don't sit around and deliberate. They act immediately because there's really only one tool that moves fast enough, and that tool is liquidity. His number here is the Federal Reserve alone, printing something like $20 trillion, with maybe $50 trillion globally when you add everyone else in. To put that in perspective, the Fed's balance sheet today sits at roughly $6 to $7 trillion. So this would mean expanding it by 3 to 4 times its current size. If you lived through 2008 and thought that response was extraordinary, this would make it look like a rehearsal by comparison. Then comes step 5, the part that actually produces the numbers everyone puts in their video titles. That printed money doesn't create inflation immediately. There's a lag, typically running a couple of years. So his sequence runs deflation first, then low inflation, then higher inflation, and by the early part of the next decade, he expects double-digit inflation, potentially heading toward 20 to 25%. In that kind of environment, almost nothing works the way people expect. Growth stocks struggle because when interest rates are high, future earnings are worth less in today's terms. Stable, slow-growing companies also struggle because their prices simply can't keep pace with rising costs. What actually works is anything with real pricing power and anything that's physically scarce, which is exactly why his targets for the following cycle land at $20,000 gold and $1,000 silver, somewhere around 2032 or 2033, with copper reaching $20 to $30. His reasoning here is the least speculative part of this whole framework. You inject tens of trillions into a system that's simultaneously building power infrastructure, data centers, and domestic manufacturing capacity. That creates enormous physical demand for metal, and there's been very little large-scale new mine development for years, so supply simply cannot respond fast enough. When demand vastly exceeds supply and supply can't move, the only thing left to adjust is price. Now, the honest disclosures, and there are quite a few this time, this is one man's roadmap, and while Hunter's framework is coherent and internally consistent, which is more than most forecasts manage, coherent isn't the same as correct. Treat this as a map of how a sequence could unfold, not a fixed schedule. He's also raised his $200 silver target 3 separate times this year, from $125 in January to $170 to $200 by the end of May, and he's transparent about that. It's worth knowing because targets that keep following price upward are partly momentum rather than pure analysis. An 80% decline in the S&P would also be worse than anything in living memory, since 2008 was around 57% and the 2000 to 2002 crash was around 49%. So 80% sits at the extreme end of what's possible. And Hunter runs a paid research service, which doesn't make him wrong, but it does mean you should weigh his reasoning rather than just the headline number. This is not financial advice, and I'm not a financial advisor, so please do your own research, DYOR, before making any decisions here. But take the shape of this sequence seriously, even if you question the exact numbers. A final run higher, a credit event, metals falling along with everything else, an unprecedented liquidity response, and then a commodity cycle driven by inflation that most people investing today have simply never lived through. Every part of that sequence has happened before. What's unusual is being told the order in advance. So tell me in the comments, could your current position actually survive a 50% drawdown without you selling? Be honest, because you're the only one who sees your real answer clearly. And let me know, does the market make a new all-time high before it makes a new low? I read every comment, and the sharpest ones get pinned. If this breakdown helped you think more clearly about the road ahead, please like, share, comment, and subscribe. It genuinely helps this channel keep growing.